Ben, this is a stark contrast. The establishment, the doctrine, if you will, for decades now has been the independence of the Fed. But there is a paradigm shift being proposed by the former president in becoming more active with regard to the Fed. Which is going to be better for markets?
Yeah, it depends on the situation, Dom. So if you think of March of 2020, where we had a real problem, at that time, the Fed and the Treasury sort of coordinated their actions. And that's when it worked out really well for markets. You remember that we got a major turnaround, whereas in the good times, that may not necessarily be the case, because that's when you get this issue about interference in decisions against maybe the wrong timing to do that. After all, the Fed is an independent institution, so I would agree with Vice President Kamala Harris that, yes, the Fed should make its own independent decisions, because too much political interference has been historically not a good thing. It has led typically to inflation or more volatility in markets. So I think the only time it could work well is in real serious crisis times, but it's more about coordination with the Treasury than that the government actively interferes. So if that were to be the case under the new administration, I do think you can expect a lot more market volatility.
Now, with that market volatility also comes a notion that the establishment, what's been happening for years now, could also be upended. Is that a concern for traders and investors right now as well? Do you think that there is a fear or an uncertainty around some of that kind of possible hypothetical change in the way that our executive branch views the Federal Reserve?
And maybe some of it, Dom, if you think about how the very low end of the yield curve is trading, right? It's it's a little bit specific, but if you look at further out, there's some risk premium priced in there. It's for deficits, but it's also for the fact that if you were to get a Fed that's not independent, that the risk of inflation may be higher in the future. Now, it still depends, though, as we go into this new phase with the new president, how ultimately the body of the FOMC changes. And we know that Powell's term is up during that first part of the new presidency, and it's still let's say a committee, right? So they're making decisions together. But nonetheless, I do think that there's concern if you're getting a Fed that's not independent and causes all this uncertainty what it's going to do next. And that's a little bit in the long end of the yield curve. So yes, it's not a good thing, I would think, Dom. We want an independent Fed, but that's better for market stability.
And before we let you go, you have an idea of how these things and cycles work. How would you be advising any future president about whether or not they should be engaged more, involved more with the Fed?
Well, there should always be a dialogue. That's always a good thing, because in a way, the Fed makes its independent decisions, but there are meetings with the government, and that takes place. Powell goes often to Capitol Hill to talk to lawmakers, as an example. And again, that episode in 2020, when he actually really worked well with Mnuchin, was a very positive outcome. So it's not always a negative to have communication, but on the other hand, it's also about the Fed is an independent body for that reason. It's the dollar, it's interest rates, it's the economy. So if you're getting other people involved that are not actively doing this day to day, then you maybe get the wrong decisions at some point, or at least wrong timing. That's the history of it. So I think, again, it's for markets and uncertainty that matters ultimately. If you get too much market instability, it's not good for the economy.